Let us now look at a question where we will be doing abnormal loss and abnormal gain, and at the same time also preparing the consolidated balance sheet. Right? So let's read the question. The question deals with abnormal loss and abnormal gain. The balance sheet as on 31st March 2012 is given to you. You have fixed assets, investment in 70% of shares of S Limited, current assets, creditors, profit and loss account, equity share capital. The acquisition of shares took place on November 1, 2011. So let's do the most important part first. Let's see the chain of events that happened. The acquisition happened on November 1, 2011. As I told you, I'll just mark this date as red. Right? However, it was informed that there was an abnormal loss in August 30, 2011. So somewhere over here, okay, let's say this date is August 30, there was an abnormal loss of rupees 10,000 for which nothing could be recovered from the insurance company. Further, there was an abnormal gain of rupees 20,000 on February 1, 2012. Somewhere down the road here, February 1, 2012, you have an abnormal gain. Balance in the profit and loss account of S Limited on 1/3/2011. Now, 31/3/2012 is the date when you are given the balance sheet. You are given that the balance on 1/3/2011 was 30,000. Interestingly, in this question, you are not given the balance on the start of the financial year, right? But 1 month before that. Prepare consolidated balance sheet, right? So as I told you, we will take one item each at a time and move forward and then prepare our balance sheet. So you are required to prepare a consolidated balance sheet. So consolidated balance sheet, right? So fixed assets 170 and 110. So we have assets, non-current assets, under which we will have fixed assets. How much? 170 plus 110. H is 170, 110. Total is 2,80,000. Then you have the investment. These will go to my cost of control. Investments 1 lakh. Right? So I'm done with this, done with this. Then current asset 180 and 185. Non-current assets, current assets H is 180, 185, 365. Right? So we're done with the asset side. On the liability side, you have creditors 150 and 90. So you'll have trade liabilities. Okay. This comes under current liabilities. H S 150 and 90. $2,40,000. Right? We have equity share for H Limited 2 lakh. So you have equity and liabilities. Right? Under equity and liability, you have shareholders' funds, in which you have equity share capital. Again, we'll just take the equity share capital of H Limited, which is 2 lakh. Let's just take it right away in the outer column. Equity share capital of S Limited is 1 lakh, out of which H holds how much? 70%. So this is going to go and sit in the cost of control. Equity share capital 70,000. The balance equity share capital belongs to the minority. So when we do the calculation of minority interest, equity share capital 30,000, right? Then profit and loss account 1 lakh for H Limited. Again, in shareholders fund only you have reserves and surplus. So let's keep the profit and loss account 1 lakh. Okay, 1,05,000 is the profit and loss account balance of S Limited. This is going to go to my analysis of profit. So the total balance that I have is 105,000 profit and loss account balance. I need to bifurcate these between capital and revenue profits, right? Okay, the acquisition of shares took place on November 1, 2011. November 1, 2011. Which means there are 7 months of pre-acquisition and 5 months of post-acquisition period. But there is an important thing which we need to note here. This 7 and 5 is what happens normally. In my case, the profit figure which is given is 30,000, but this is on 1st March 2011. So from 1st March 2011 until the date of acquisition, which is November, how many months are there? It's 8 months actually. And 5 months are here, right? So instead of taking this as 7, I will take this as 8 because this is the ratio in which the profits or the difference is going to be allocated. So what was the balance on 1/3/2011? The balance is 30,000. 30,000, which means between this date and 31/3/2012, I earned 105 minus 30 or 75,000, right? But there are some adjustments as well. What are these? It was informed that there was abnormal loss in August 30, 2011 for 10,000 and abnormal gain of 20,000. Now, because these are profits which are after abnormal loss and abnormal gain, we need to adjust those two items and then take them to the relevant profit, right? So we will add the abnormal loss, we will reduce the abnormal gain. This is 20,000, this is 10,000, right? 30,000. The reason why I have done this, in case you want to have a look at it in detail, you can go to our previous questions where we have shown the treatment of abnormal gain and abnormal loss in detail. 65,000, right? Now this 65,000 is in respect of 8 plus 5, 13 months, out of which 8 is pre and 5 is post. So I will distribute this 8 months pre-profit, 8 upon 13 into 65,000. I will reduce from here, which will give me 40,000. And I will add 40,000 to the pre-acquisition profits. This is something called time adjustment. Based on the ratio of time between pre and post, I have allocated my normal profit. This is the normal profit that I have earned if these losses and gains would not have happened. So this gives me 70,000. This gives me 25,000. Right? Now, please note that whatever adjustments you do here normally are to be reversed unless and until there is a one-side impact which has already been given. So if I reduce this abnormal loss, I need to reduce it from pre or post depending on what was the date when this happened. And this I can find using timeline. So when I see the timeline, the abnormal loss comes prior to the red line, right? Which means that it is a pre-acquisition event and abnormal gain is a post-acquisition event. Less abnormal loss, 10,000, add abnormal gain, 20,000, this gives me 60,000, this gives me 45,000, right? I allocate this between the holding and the minority, which is 70% and 30%. So this will be 70% of 60,000 or 42. This will be 18. Again, this will be 13,500, 14, 15, 31,500. Now I need to take these respective balances to the respective places. So this is the pre-acquisition profits. So obviously this is going to go and reduce my cost of control. Pre-acquisition profit. How much is the number? 42,000, right? And 31,500 is the profit. So 42,000 comes here. 31,500 I can just add to the consolidated profit and loss account. Now this becomes consolidated profit and loss account plus post profits 131,500, right? Now insofar as minority is concerned, we can just take the total of these two. 18 plus 13,500 gives you 31,500. This is their share of profit, 61,500. This gives you 112,000, 12,000 capital reserve, right? So minority is 61,500. It should actually come somewhere here only, 61,500, and capital reserve is 12,000. This should have been included in the reserves and surplus here, but because we don't have space, I'll just write it over here, 12,000. Ideally, in terms of the disclosure requirements, you should just add on the capital reserve and all these things in an annexure separately and put the total here as reserves and surplus. Right? Should we do the total, please? So this is 280 plus 365. This will be 6,45,000. And let's see the other one as well. So you have 200 and 131. So this will be 331,500. Right? Plus 61,500, sorry, okay, let me do 55,000 more here, 252, 6,45,000, right? So what we noticed was that if we kind of just move in a synchronized manner without deviating too much here and there, giving impact to both the debit and the credit aspect of a transaction, it becomes fairly easy to solve the questions relating to consolidated financial statements. I hope you would have liked this video. If yes, you can please hit the like button. You can go to our website iodubook.com and watch many more such lectures which are there and which are yet to come in the course of time. This is Aranjay, your educator for this video. Thank you for being with us today.